Thanks, Bipin, for the great introduction, and very happy to see all of you. As Bipin mentioned, auditing is becoming more and more important nowadays. Not that it was not important earlier, but somehow so much importance was not given earlier. It was kind of taken for granted. But now it is gaining more importance because the regulator is also closely looking at it. And in our day-to-day situations, especially those firms who are handling the clients which are subjected to NFRA or MCA inspections, these have become very common themes nowadays. And therefore, auditor is also under the scanner, so to say, as to what extent the auditing standards have been complied with by the auditor. And as Bipin mentioned, it's like a bread and butter for us, those who are into audit. And if we don't follow the auditing standards to the T, then obviously we are not good auditors, right? That's something which we'll have to accept to ourselves. And that is the reason it becomes more and more significant as to how do not only do the audit rightly, but also how do we demonstrate that we have done the audit rightly. Those who would have seen some of the NFRA discussions or NFRA publications, NFRA has gone to the extent to saying that whenever the auditing standard uses the word shall in the paragraph, shall means it's mandatory for the auditor to do it. So you can't take it lightly if the auditor says, if the standard says that this shall be done or this procedure shall be done. So when it is shall, you have to do it as auditor. So it's as simple as that. And auditing standard per se are not so complex to understand, right? But somehow the reason it doesn't get followed is because that is what we have learned in our articleship. When especially we do it with a little small firm or a middle-sized firm, the clients are not that complex and therefore the risk is also not very high. But I think gone those days now, and we should not be thinking that the risk is not so high, which is true in all the professions, right? If we see medical profession, if we see our profession, slowly and slowly the risks are getting higher, and therefore the professionals are getting questioned as to what extent you have fulfilled your responsibility, not only when the things go wrong, but even otherwise also. So I wouldn't saying that it's only for the risky client where one will think about auditing standards. Even our day-to-day business, it has to be part of our, it has to be in our blood as auditor, that we follow these procedures. The way we get up in the morning and we do a regular course, same thing should happen with the auditing standards where we are doing the audit. It has to become part of our routine, and that is how we will give that to our next generation also, who are interns, article trainees, etc. That is how they will learn and they will carry it forward. So without wasting much time, there are four topics which I am covering today. One is the external confirmations, second is going concern, third is subsequent events, and fourth is audit of accounting estimates. So we'll start with the first one, which is external confirmation. Now I don't need to explain as to what does the external confirmation mean. We all know saying that these are essentially the confirmations which I send to various parties, third parties, right? So as an auditor, rather than getting the confirmation from the client, I get the direct confirmation from the third party. It could be a debtor, it could be a creditor, it could be a party to whom the lease deposit has been kept. So lessor, it will be a bank from where I'll get the bank balance confirmation. So any confirmation which I'm taking from the third party as auditor directly, so it's a communication between the auditor and the third party, that is called as external confirmation. That's why it is external. But there is something more to it, and that's why I want to kind of, in this session, I just want to bring out those things which somehow we miss. So a confirmation is not only about the balances which exist. The confirmation could also be to confirm that something does not exist. For example, there could be side agreements which are entered with the party. So there is one agreement which we see as, let's say, lending agreement between the two parties. The company has taken a loan from another company, and there is a borrowing and lending agreement, which is given by the client to us as auditor. We go through that, and simple process will be I go and I confirm the balance with the third party saying that this is the balance as at 31st March. That's a simple confirmation. But my confirmation can do something more, and confirmation can also saying that, also confirm that apart from this agreement, there are no other agreements which you have entered into with the company. So that is called as side agreements, because it's quite possible if the client is not good, then he would not produce the side agreements to the auditor for his own, meeting his own objective. And then auditor will never come to know that this agreement ever existed. This typically also happens in bank confirmations, because in bank there will be various forward, let's say the company is using Forex. There could be various forward contracts which the company would have entered with the bank, how would you know as an auditor that this list is complete, which the client has given to you as an auditor? So to ensure that completeness, the bank confirmation can also include this clause, which is absence of any additional transactions, so that it gives you a complete confirmation saying that this is all what the company has and the other party has also confirmed it. Yes, please. Not necessarily. This would be common for loan agreement also. Like the company has taken a loan and I'll confirm with the lender that there is no agreement other than the loan agreement which you have entered. But what you're saying is right. This would be very common in case of legal confirmation. So there is also a confirmation sent to the legal advisor of the company to ensure what are the litigations which are going with the company, right? Because as an auditor, how would I know the completeness as to what litigations are happening unless client tells me, and client may not tell me. And the reason I need to know as auditor, obviously, because my contingent liabilities will depend as to what litigations are going on, or maybe some provisions may be required if the client is losing the case. So there, it's clearly a negative confirmation kind of thing, saying that nothing more than this going on, which legal counsel of the client will confirm. But yeah, apart from legal, it could be even other cases as well. Yeah. In fact, I'm quite happy. If you have any questions, please raise your hand because I would like to have. Yes, ma'am. So essentially, the confirmation will say saying that. So in confirmation, of course, essentially it says we are the statutory auditors of so and so, so and so, and for the reason we are communicating with you is for the purpose of our statutory audit. Then we say saying that we understand these are the transactions, so these are the agreements which have been entered with you. Kindly confirm the above, and if there is any other agreements or other transactions which you have entered into with Messrs. So and so, whatever that company's name is. So therefore, if the other party confirms saying that apart from this there is something more, then the auditor will come to know saying that this additionally exists in the client's case, which the client has not confirmed or informed, either intentionally or sometimes even non-intentionally, because many times the client's finance department may not be so well organized that they will have a proper list of all the forward contracts, let's say, which they have entered into with a bank, because that is typically with the treasury. And treasury department and finance department, how much communication is depends on how the client is structured. So in those cases, this kind of negative confirmations or absence of not having anything also helps. As far as design of the confirmation is concerned, the standard talks about as to what all should be included in the confirmation, etc. But the 2 points which I highlighted here, one is the fraud risk. Because confirmation is considered as the supreme evidence, so to say, for the auditor to ensure that there is no fraud taken place. Because instead of having it from the client, if I have it from the third party who is confirming it, then that obviously is the supreme thing to have, because then I directly have a confirmation from the third party as auditor, and not only with the client, because client may misguide me or may give incorrect information to me. And the second thing is, some confirmations can confirm only the total amount, whereas some confirmation can even go based on each of the invoices. Like typically in our CA studies also, we have learned the very basic fraud, which is streaming and ladding. So the debtor is paying for latest invoice, but the company is adjusting it against the oldest invoice because there is some fraud which is happening and they don't want to show the old balance outstanding, right? So in many cases, the confirmation can have the invoice wise breakup as well, to say saying that confirm that these are the invoices which are unpaid if I'm sending it to the debtor, or if I'm sending it to the creditor, the other side, saying that these are unpaid from the company's side. So those kind of confirmations also could be there. So confirmation, so to say, have to have certain minimum requirements, but depending on the situation, the auditor has to think as to what kind of confirmation he or she would like to send to the third party, which is debtor, creditor, bank, legal counsel, lessor, anyone. The common errors which you see on the right side box, these are the common errors which we see, and unfortunately what happens is, all said and done, external confirmation is the audit area which is given to the junior most person in the firm. He is intern, he's a trainee who prepares those letters and posts it and sends it. And at a partner level, normally partner does not get so much involved into it. But this is very, very important procedure, and therefore it is required that partner or director or senior person's attention is there as to how this process is being carried out, because these are the common errors which we see. Obviously, because someone who is junior does not understand the sanctity of this, he doesn't understand the seriousness of this. One of those items which I think Lamia will also cover later which is observed by QRB or NFRA is confirmation log. That is, the audit team or the auditor is required to mention the log of confirmation which will confirm as to who are the parties to whom confirmation was sent. Was that delivered or was that returned back because the party address is not found or whatever. If it was delivered, then have you got the response, on which date you have got the response, because obviously the expectation is you should do it with a sufficient time in hand. That is, it should not be sent at a very fag end of the audit, because by the time you receive the response, the audit is already over. This should be sent at the beginning of the audit. So there is sufficient. So this log will actually show saying that which are received, on which date those are received, which are not received. And then whatever is not received, then there are other audit procedures which auditor is required to carry out. So the point is, it's not good just to send the confirmations. It is equally important to have the confirmation log in the audit files, which will explain saying that what procedure has been carried out. Now what happens if I send the confirmation and the other party doesn't reply at all? As an auditor, does my responsibility gets over? If you see the standard, it says no. You can't just say saying that, okay, I sent the confirmation, the party didn't reply, what do I do? That's not the answer. If you don't receive the response, then you're supposed to send the follow-up request, because it might happen that the other party might have missed it or they have not noticed it, whatever. So as a minimum, at least one follow-up request should go from the auditor saying that we have sent this confirmation and we are awaiting your response on that confirmation. If that is not done, then again that would be non-compliance with the auditing standard, and which would mean that we have not done our duties with a sufficient care. Now there could be rare cases where management may refuse to send the confirmation request, because when the auditor is sending the confirmation, obviously it is routed through management, right? It's not sent it in confidence as such. The management knows that these are the parties to whom auditor is sending the confirmation. Now, because it is management who is going to give the data about what is the outstanding balance, what is it in the books of account, etc. And that is how the confirmation will be drafted. So management may say no, saying that they do not want to send the confirmation. If that is the situation which we come across, what it requires is, first, of course, the auditor has to understand what is the reason management has said, management is saying no or management is refusing, and whether that refusal is reasonable enough. There could be cases, right? For example, let's say there is a legal case going on, there is dispute happening in the court. Then management might not like to send a confirmation, because in a way it will confirm the management's position and what is there in the books of account. So they may say no, that they don't want to send a confirmation to that party. That is understandable. But if there is some other reason, or if there is no reason which management gives, then that is not acceptable. In fact, that is something which should raise the eyebrows of the auditor as to why the management is saying no and why it is refusing, because if the transaction is genuine, then what's the problem in this transparency and sending the confirmation? And let's say in spite of doing all this, the management simply refuses as to they do not want to send a confirmation. Can the auditor send a confirmation? The answer is no, because the details will be given by the management about that party's name, party's address, balances, etc. But in such case, that is considered as a scope limitation. By scope limitation, what it means is, as an auditor, I could not do the audit procedures which I was supposed to do as per the auditing standards. So my scope is limited, though I want to do it, but I am unable to do it. And which requires the report modification in the audit report to explain saying that I have not been able to do these procedures because of so and so reason, because of the scope limitation. Because then that would mean that I am issuing the audit report without completing the complete audit procedures. These are the examples from the standard itself, which talks about saying that, not standard, there was a publication by the institute about the modified audit reports. It's available on the net. So you can see it's a very good publication which says what are the different areas in which audit report was modified by the auditor. But these are a couple of examples from there where the auditor has explained that there was a scope limitation and external confirmations were not sent to the external parties because of management's refusal. Now, when I receive the confirmation, these are something do's and don'ts, which are picked up from the standard and also from the usual practice what we see. The best way of getting the confirmation if the party doesn't reply would be actually to go and collect it from the party, right? Someone from the audit team can go. This happens very commonly in banks, where if the bank doesn't respond, someone from the audit team can go and collect it from the bank, and bank will give that. Maybe client's person can accompany, but it should be never that it is directly collected by the client, because then the whole purpose is lost. Then there is no external confirmation one-to-one because the client gets involved. So that is the best evidence where someone goes and collects it. But otherwise, yes. If there are what, 5 branches? Huh? Yeah. So first of all, confirmation should be sent. Okay. So even if it's a foreign branch, because there is no exception per se to foreign parties. So even if there are foreign parties, confirmation should be sent. Normally, the foreign banks have the process where they have one BPO or KPO somewhere, because the branch is not allowed to confirm the balance directly because of their own internal procedures and fraud risks, etc. So they would forward that confirmation to their internal center, that BPO center, whose job is to confirm these balances to various parties. So that BPO center will send that confirmation directly to the auditor. That's what we have seen normally. But if you don't receive it, then yes, then the next process will be you will send a reminder and you will wait if you get that confirmation. If that is also not possible, then you will check with the client if the branch is ready to give, but normally branch does not give that confirmation. So branch will refuse. And then you will stop, because then there is nothing more that you could have done as auditor, because you have sent a confirmation, you have sent the reminder. In spite of that, nothing has happened. And your confirmation log, which we spoke earlier, that will show that you had on this date you sent the first confirmation, on this date you sent the reminder, and nothing has happened after that, right? Also, if yeah. Sorry, any what? Reply. So reply is either it could be by post. So when the confirmation is sent, that time along with that there will be also self-addressed envelope, so to say, which will be sent, so that that envelope comes back to our office, right? So that envelope will have our office address. It will also have name of the person who is supposed to receive in our office, because in large offices the confirmation may just get lost. So typically it will have name of the partner or someone from the audit team's name given, so that he receives it. So that is by post or by courier or by speed post. The other way is there is also internal software. So all large firms also have the internal software for doing the confirmations. So it is through electronic mode by which it is sent to the debtor or creditor, etc. And then the debtor or creditor responds back. Now the good point which you raised is it is also important for the auditor to understand who has sent it back, because sending is one side which we have done. But if at all there is going to be a fraud, then the other party who is sending you back may not be the actual party to whom you sent it, right? In fact, very recently, in last month, we came across this situation, and that was a very good situation which the audit team, to be honest, the junior member in the audit team identified that the party to whom we have sent a confirmation, let's say abcd.in was the email ID of that trade receivable, that is data. But the confirmation which you received back was not abcd.in, it was bacd.in. So there was a slight change in the receipt of the email ID from where we received it. And then obviously it went to the client and we probed further, and what came out was, yes, it was a fraud where someone in the finance department at the client's place, because person in the finance department knows to whom you have sent a confirmation, because that is how you are sending it through them. He was responding it and not the actual debtor, right? And obviously he was responding with a wrong balance which is there in the books, which was not the genuine balance. So not only sending the confirmation is important, equally the receipt of confirmation as to understanding the genuineness or authenticity of the person who is responding to it is also equally important, especially when it is an electronic confirmation, because in electronic confirmation it is possible that someone else is sending you by email by just slightly changing the email ID. Also to understand as to, even if you get it from the right email ID, what is the level of that person who is confirming? Is he authorized to give the balance confirmation, or is he very, very, let's say, junior guy in the team? Because then that doesn't help, right? As far as bank confirmations are concerned, you would know that there is also a portal, external portal, which is available. But institute is, I think, sometime in 2019 or 20, institute has issued a guideline that we should not be using that external portal, because the authenticity, the testing of that portal, etc., has not been carried out by the auditor. So we cannot rely on that external portal. But in some of the outside countries, it is common where there are companies who do this, and they liaise between the auditor and the other party to get the confirmation process smooth. Now, if I don't receive the confirmation, then what am I supposed to do? Can I just rely on the book balance, or can I simply put it in that log saying that I didn't receive, so that's it, I'm done? But that's not the answer. If we don't receive, then expectation is that we do more alternate procedures, because what is our goal as auditor? Our goal as auditor is to get the assurance on the balance which is lying in the books of account. So I can't get the assurance if other party is not confirming it. I can't just rely on the client. I'll have to do something as audit procedure, right? And then therefore these are various scenarios where one can do alternate procedures. One can look at the subsequent receipts. One can see the correspondence with the other party as to against which invoices those receipts are received. How does the client manages the subsequent receipts? If there are no receipts received subsequently, then going back to the original transaction and tracking it, saying that are there agreements, POs or sales orders, etc., against which these transactions were done. There is also, yeah. Yeah, now that's a good point. Bipin has asked, saying that if I don't receive the confirmations, some of the confirmations, let's say, and of course I'll do these alternate procedures, but if I don't get much comfort even alternate procedures, then what do I do? Should I put it in the notes to accounts of the client saying that the confirmations are not received from the party, so this is subject to confirmation? Let's say balances in the trade receivables are subject to confirmation. Can I do that as an auditor? Any views? He's saying no. No? And why no? Yeah, I agree. So therefore, see, these are the audit procedures which auditor has to carry, whereas notes to accounts is part of the financial statements which management has to prepare. So management, according to management, that is true and fair, whatever balance which they are showing in the receivables, payables, bank, etc. Auditor is not able to get that comfort. So if I am not able to get that comfort, then I will have to bring it in my report, and it will not go in the notes to the accounts which are prepared by the management, right? Now the question will be, of course, then the other things will come up, like to what extent I did not get the comfort. Like one example which we saw, two examples, which was the scope modification, scope limitation, and therefore auditor qualified, because he said I could not do the confirmations and alternate procedures, so I am not getting comfort on the receivables or payables. I would not get into the QRB observations or NFRA observations, because our next session Lamia is going to take on the same topic on NFRA observations. Only one thing maybe I'll say here is, there are situations where the audit files which are maintained nowadays are in electronic format. There will be audit software which firms uses, and many of these confirmations could be in the hard copy format, because the letters are sent and those are received back. So it is very much expected by the regulator that everything is kept together. I can't have situation where my hard copy file is lying somewhere and my electronic file is there on my laptop which says confirmation is sent, but copy of the confirmation I don't have, because it is lying in the file. So regulator expects everything is kept together. So typically one will scan it and put it in the electronic file, so everything is together. But there are many other observations which I won't cover now, because that is anyway in the next session. So before I move to going concern, any question on the external confirmations? Yes. Yeah. Yep. Yes. Ha. Correct. So something which maybe this gentleman also asked for foreign banks, right? Saying that let's say every year I send confirmation to foreign bank doesn't respond. Okay, then can I say anyway it doesn't respond? So I'll document saying that last 3 years it is not responding. This is the 4th year. Why should I send the confirmation? The answer to that is no. There is no exemption which the auditing standard gives. So every year you have to keep trying and keep trying. Hopefully the other party will respond. But having said that, if one would also think saying that why that other party is not confirming. Like we had many cases where the other party didn't confirm, and then there were some other situations also which kind of started making us think saying that is there any fraudulent transaction happening here. Especially it happens when there are large dealer networks or distributor networks across India, and therefore you are confirming the balance with distributor is not responding. It is a small party or some family firm or something like that, partnership firm. But when we actually started looking into it, those firms didn't even exist. Those were all sham transactions in the books. So there was no transaction, there was no sales made to that party. The party also didn't exist. It was just shown to kind of pass the wrong entries and do the fraudulent bookkeeping. So therefore existence of that party also becomes quite important to say saying that how do I know whether that party exists or not if I don't receive the confirmation from that party. And usually if I am the auditor, I would also go back to the sales team, because sales team is always in touch with the debtors, or purchase team is always in touch with the creditors. So they would know about that party. They are regular in touch for recovery or for making payment, etc. And therefore they can always request the other party that you would have received the confirmation from the auditor, so please respond to the auditor, right? So I would be little surprised if the company says we also do not know why he is not responding, except foreign banks where I can understand that bank is not under control, so they have their own processes. Yeah. It is mandatory, yes. I should send the confirmation. Now many banks will say, please refer attached annexure, and then they will have their own format of annexure and they will send it back, because they will not keep writing and filling up our form, which is okay. But at least that is a direct confirmation which I have received from the bank, and I am not relying only on the bank statement. A very simple fraud which again we came across recently, and the company is going for public listing now. So the DRHP etc. is not filed, but it will get filed, and then you would notice in DRHP because it will become public. A very simple fraud done by that person, middle level person in the finance team. What he used to do is from the bank statement, which typically comes by email, on that he will delete certain receipts and equivalent amount of payments. So the balance will match. And when it is given to the auditor and the auditor was looking at it, okay, the bank balance is matching, book balance is matching, for the difference there is a RICO. But some of the equal transactions, plus and minus, are wiped out and therefore not recorded in the books. Never came to the notice until confirmation happened, and in that confirmation the transaction-wise statement was given by the bank. And of course some debtors also said saying that we already made the payment, so why you are asking us for the confirmation. That is how this whole thing came to light. So bank confirmation is also equally important as much as the third party like debtor, creditor, lessor, legal counsel, etc. Legal counsel also, we came across one case where when we sent to legal counsel, that time we came to know that 2 shareholders of the company were fighting, and both of them have put certain charges on the company itself. So company was also exposed, which management never told us, now shareholders told us, because they were fighting and they never wanted to show that in the company's books. So because the auditor is completely supposed to be a third party, right? We are completely independent from the client, and therefore we should get all these independent sources as much as we can. Again, the idea is not that we are bloodhound, as we always keep saying, but the fact that we are not bloodhound doesn't mean that we should keep our eyes closed. We'll have to do the basic requirements of the standard, which the standard requires us to do. So I'll move to the next topic, which is on going concern. As a concept, I guess we all know going concern. Essentially, this is a very different auditing standard, because all our auditing standards are relating to the historical transactions which we audit, and going concern is all futuristic, right? Because by this, what the auditor is kind of confirming to the outside world that this company which I am auditing, the auditee, will continue at least for next 12 months. It will keep going, it will keep running. That is what going concern is, because that is one of the fundamental basis on which all the accounting standards are developed. If I'm having a property, plant and equipment and claiming depreciation on it, saying that the useful life is 5 years or whatever, the company has to run for 5 years. If the company itself is going to close in next 12 months or within 12 months, then the useful life of 5 years makes no sense, because you don't have the company to use it for 5 years, right? So that is very fundamental concept. And as difficult it is for auditing the historical transaction, you could imagine how difficult it would be to audit the future, because the auditor is not a fortune teller to confirm saying that yes, this company will run. What happens if the auditor clears the going concern, that is, does not qualify the report, and after 8 months the company winds up, right? Then everyone will raise the finger on the auditor, saying that what was auditor doing, and how come auditor did not catch that this company will going to close in 8 months. So it is that significant, the going concern concept is, and not only for bigger companies, it could be even for smaller companies also. So it's slowly getting difficult now for the auditor. Like you will see all these news items, especially when those are bigger companies, that will always come in media. This was sometime in April, May, where though it is US, but Donald Trump's media company, they themselves explained, saying that they may not continue as a going concern, and obviously the share price fell down with this. So there are clearly responsibilities given for the going concern in the auditing standard itself. It talks about what are the responsibilities of the management, what is the responsibility of those charged with governance, and what is the responsibility of the auditors. Management is the one who is a preparer of the financial statements, typically the finance team and the board of directors, etc. Those charged with governance would be the audit committees, who are supposed to monitor the governance of the company, and auditor, as we know, all of us, right? So different people have got different responsibilities, but everyone is supposed to look at the going concern. So the first starting process always will be the management. First, management has to assess as to whether they will be able to continue for next 12 months or not. The second, if the management has done the assessment, the audit committee, that is those charged with governance, they are supposed to evaluate whether management's assessment is appropriate or not, and they should challenge the management. And then comes the auditor as well. Auditor is also supposed to evaluate as to whether management's assessment is acceptable or it is not acceptable, looking at the auditing standard and looking at the conditions which the client has. Now the biggest problem of going concern is, because it is so fact specific to a particular client, one can't say saying that kind of one size fits all, and this is the thing, I do it, I put a checklist and it is done. Because every client may be going through different circumstances. Every client may have different reasons why it may not continue as a going concern. And we have seen so many companies, like especially in startups. India is kind of a home for startups, as we say. And so many startups came up and also went down. At time they were doing so good. And today, if we think of, we don't even hear their name. We don't know where they have vanished, right? All those companies have dried down, they're gone. And when the company goes bust like this, every stakeholder is going to claim. There will be bankers who have lent the money, there will be customers, there will be suppliers who have supplied the goods and not receiving their money, the shareholders whose share price is eroded. So everyone would be there asking for the question, saying that what was auditor doing? Why did auditor did not tell us about this? What is the period for which, yeah. Yes. Correct. Yeah. Yeah. Correct. Right. Correct. Exactly. You are very right. So my going concern, reason of company not continuing as a going concern could be various. The very basic thing which we come across commonly is liquidity issue, that the company doesn't have money, and therefore how will it survive? Because it is making losses, especially startups, they are making losses, finances are dried down, there is no one now ready to lend them. So how will they survive without money? They spend a lot of money, literally blow the money on advertising. So huge cost on in startup P&L for advertising. So that is how they burn the cash. But the companies other than startups, or even startups, there could be cases for the way when you said is regulatory issue, that the regulator has seized the license So if the license is taken away from RBI, for example, how will you run the business? Because you are not allowed to do the business without a license. Um, there could be another case where, like we had one case, listed entity, where it was 3 or 4 years ago, and because it's listed, it's there in the audit report, so it's a public knowledge, Mandhana. So Mandhana was the case where it was a dealer of Being Human, that brand which was, Being Human, Salman Khan's brand. And then Salman Khan stopped the contract with the company. He said, now you are no more my distributor after 31st March. The contract comes to end. Now what will company do? Because Salman Khan signed with someone else. So it was a going concern issue, and therefore if you see the audit report of 2019 or 2020 sometime, you will find that qualification by auditor saying that the company's contract has come to end and company doesn't have any other business, because that was the only brand which they were selling. So there was a going concern issue for that company that time. So it need not be only liquidity issue, it could be the business issue also. There are cases where the company's plant, because of fire, the plant is gone. Now how will the company, if there is only one plant, how will the company manufacture? If they can't manufacture, how will they survive? Unless they have money to start the plant again. There are cases where the plant has been sealed by the regulatory authorities because of the chemical pollution, etc., which they did in that area. And because the plant is sealed and the case is going on with the National Green Tribunal, etc., we don't know when the company will start, because it will take years now to start. So company may not survive because of the regulatory issues. They have a lot of money, but that money doesn't help because your plant itself is sealed. So, and you are not allowed to sell anymore because of the pollution, etc., which they did. So there could be many reasons why going concern may come into question, right? There could be a simple thing as debt covenants, that company has taken a debt, bank has asked certain covenants to be met, covenants are not met, and if covenants are not met, bank has the right to ask for the loan. So your loan was term loan, but now it has become a short-term loan, because the bank will ask for the repayment immediately because you did not meet the covenants. And obviously you would not have so much of money to pay to the bank. So again, going concern becomes a question. A very common thing was COVID-19. In COVID-19, the revenue became literally zero because there was a lockdown. The movie theaters, how will they run? Because there was no movie, nothing was allowed. So the revenue in that entire year, if you see, the top line is zero, which used to be crores of rupees earlier. Previous year is crores of rupees, current year 0 rupees, because they couldn't sell anything. Now those who had deep pockets, they survived. But those who were anyway doing losses or very much on the brink, we see so many movie theaters got closed right after COVID. So all those where, if you see the reports, you will find those going concern problems discussed by the management as well as by the auditor. One good point or one interesting point here is that the management and the auditor both have to be in sync while deciding whether the company will continue as a going concern or not. That becomes a little bit of issue because there's a bit of tussle. The management will always trying to prove that yes, the company will continue for next 12 months. Now it becomes a challenge on the auditor as to how to accept that management's assessment. But the standard also says that for some reason, if the auditor is not able to accept whatever management is saying, then the auditor will have to qualify the report, because then he would say saying that management's assessment is not appropriate. It is a disagreement. But those situations are rare. Normally you will be able to push the management, because management also has got its own responsibility under the Companies Act to ensure that their financial statements are true and fair. So they can't show something wrong in the financial statements. As far as the period is concerned, that for how long do I see whether this company will continue or not, the standard says it is 12 months from the balance sheet date. So I'm signing March 24 today. I'll have to ensure at least up to March 25 the company will survive. But in practice, what we do as auditors is we say, I shouldn't see only for next 12 months from balance sheet date. We at least see next 12 months from the report signing date. So if I'm signing the report today on 29th of June, end of June, I will ensure that at least up to June 25 the company will continue, and not only up to March 25. So 12 months from the balance sheet date, that is how typical report date. But having said that, it is not sacrosanct. So if I know that up to March 25 the company will survive, but I know that in June their contract is getting over, and therefore they will not survive after June. So I wouldn't say 12 months can't be stretched to 15 months. When the auditor has that knowledge and also the management has that knowledge, then of course they have to consider those facts. It can't be said saying that I'm looking at 12 months, yes, March 25 the company was there, and in June it wound up. But as an auditor I have fulfilled my responsibilities. That would never be acceptable position for the auditor. there are various scenarios which I was talking about, but that somewhere I covered, saying that one will see whether I have the cash balance for at least next 12 months. If I don't have the cash balance, then whether my banking facility or borrowing facility will continue, or is it expiring? Because if it expires, then again my finances are dried down. But what I would like, sources of finance could be list of finance. It could be bank borrowing, it could be overdraft, it could be letter of credit, it could be discounting of the debtors. N number of finances are available today. So it will be client to client depending on which finances they can raise and how they raise the finance. But what I want to cover really is the 5 scenarios which going concern. So you have to see the going concern concept like a spectrum. Yeah, thank you. So how does that work? The red color is getting over somewhere and the orange is starting. Then the orange is getting over somewhere and then the green is starting. So it's like a spectrum, right? Your going concern scenario also will be like a spectrum. You can't say the client fits into, there are 5 scenarios. You can't say the client fits into this or this or this or this or this. You'll have to see somewhere in the middle as to how it is moving from one scenario to the other. So what are those 5 scenarios? One scenario is your client is all good. There is no issue of going concern. Everything is running well. You don't have any problem. Client doesn't have any problem. Good cash. So that's a very starting point where everything is going well. So I don't have to do anything as auditor, right? Because going concern is the basic fundamental assumption for the preparing accounts, and that is presumed. So I don't have to say anywhere, either in the financial statements, management doesn't have to say anything. As an auditor, I don't have to say anything in my audit report if everything is good and the company is going as a going concern, which is the case in most of the clients, I'm sure, because as an audit firm, we'll also like to take those clients which are going concerns. Scenario 2, which is considered as a close call. So what close call means is now it is little worse than the first scenario. Everything is not good. Okay, something is going wrong. But even if something is going wrong, there are mitigating factors to that. And therefore the company will still survive. It's like today I'm very healthy. Tomorrow, okay, I got a little bit of fever, but I also got the medicines. So I'm not going to die. Because then I also have the mitigating factors, though the health is not good. Something similar for the company, that there is a financial crunch. Company does not have the liquidity when we see the balance sheet, but then the company has got some support. There is a banker who is available with whom the agreement is signed, and therefore company go and withdraw that amount as a loan, and company has got possibility to repay that loan as well. So therefore there is this mitigating factor. So there is a bad situation and there is a mitigating factor that is considered as a close call. Okay, that is very close. It may not continue as a going concern, it will continue as a going concern. It's just kind of on the border. Now what do we do when there is a close call? As an auditor as well as a company. What is expected is that the company in the financial statements should include a note, because company has done the assessment of its going concern and they come to know it's a close call now for them. So they should include a note which will explain what are the issues relating to going concern, as well as what are the mitigating factors which they have, because of which they believe that going concern assumption is appropriate, and therefore the financial statements are on going concern basis, not on liquidation basis. So that is what the management has to do as a minimum, so that the reader should know that that is where the company stands. It is on the brink. As far as auditor is concerned, auditor is not expected to do anything because the company is on a going concern. In rare scenarios, if you see the implementation guide of the institute on this auditing standard SA 570, it says saying that in some cases auditor may consider including the emphasis of matter, EOM paragraph. So he's not qualifying, but he's just drawing the attention to that note which the management has given, which says that the company is not in a good condition, but at the same time they also have the mitigating factors. So that is what is called as close call scenario. So the way I say the spectrum, we started from a good situation to a close call situation. Now if it goes further worse and it is not even a close call, then the next situation goes as MUGC, material uncertainty relating to going concern. So material uncertainty relating to going concern would mean that I have even crossed the close call and my situation has become even worse, and I don't have a mitigating factor for certain. It is uncertain. So there is a going concern problem, but there is a material uncertainty whether I will continue or I will not continue, whether the bank will give me the loan or it will not give me the loan. I am in negotiations with the bank by the time the audit gets signed, but I don't have a confirmed letter from the bank. Bank may accept my proposal, then I will survive because I'll get the money. Bank may not accept my proposal, then I will die because I don't have liquidity. So that is a material uncertainty relating to going concern, whether this company will continue, this company will not continue. There could be litigation going in the court. I don't know what the court resolution is going to be. In the real estate, many times it's very common because the land is under litigation and their entire project is under question. Now, if the court doesn't accept company's position, they will die. If the court accepts company's position, they will flourish. So there is a material uncertainty whether company will continue or not. That is called as MUGC scenario. In MUGC scenario, again, the management has to give the note in the financial statements, very clearly stating that there is a material uncertainty related to going concern. And the audit report will have a specific paragraph which will have the heading material uncertainty related to going concern. It will not be called as emphasis of matter paragraph. It will be a separate paragraph which will say MUGC, material uncertainty related to going concern. And then the auditor will refer to that note, as well as he will explain in short that the company is having a material uncertainty relating to going concern. Typically this is how that paragraph would look like. I just picked up one example where the auditor's report, if you see, after basis, the opinion is not qualified, basis of opinion also is clean, but then there is another paragraph which talks about material uncertainty related to going concern. It's from a published report, and there the auditor has explained what has happened to the company, and therefore it is a material uncertainty related to going concern. So if you see, what has happened is, we started with the spectrum. We started with a very clean position, one client which was very clean. Then there is another client which is little bad, which is a close call scenario, which is on the brink. Then this is a third client which is even worse, which is a material uncertainty related to going concern. Then what could be the worst? The next fourth stage could be that there is not only one material uncertainty, there are multiple uncertainties related to going concern. So it is, let's say, I don't have a money, there is a negotiation happening with the bank. So whether I'll get the money or not, that is one uncertainty on the liquidity side. There is another court case which is going on. The court will also decide whether I can continue, I can't continue. So there is another uncertainty. So if you have more than one uncertainties, that is multiple uncertainties affecting the client, then the auditor will have to disclaim the opinion. That is called as disclaimer. Because then I can't say whether financial statements give the true and fair view, because there are so many uncertainties involved. And as an auditor, how do I decide as to which uncertainty will be in client's favor and which will not be? And therefore that goes to the fourth scenario, which is the disclaimer of opinion. Now, the standard also says that these situations are very rare. You will not come across these situations so often. Like in my career also, I would say only 1 or 2 situations I might have seen where I've seen this kind of situation where there are multiple uncertainties. But if that happens, then that is what auditor will have to do. He'll have to disclaim the overall opinion. The reason overall opinion gets disclaimed is because the basic fundamental going concern itself, auditor is not comfortable with on the financials. And the last situation where the company is not a going concern, but company believes that it is a going concern, auditor believes it is not. So there is a disagreement. So if it's a disagreement, then the auditor will have to give the adverse opinion to say, saying that we don't agree with the company. They believe it's a going concern. We believe it should have been prepared on a liquidation basis. So again, this scenario should not normally take place because if the auditor and client both are professionals, they should be able to come to the understanding and evaluate the situation independently without having too much of emotions involved in that battle. But that's the fifth scenario. So if you see the spectrum, again, we started with a clean. From clean, we moved to close call. From close call, we moved to MUGC. From MUGC, we moved to disclaimer. And from disclaimer, finally adverse. Disclaimer and adverse, as I said, are rare. But first 3, you would find very common. The first is very common, of course, that is what most of the clients are. But then you'll find close calls. You will find MUGCs, even in the listed entities also. So when it goes well, everything is good, and therefore you don't worry much on the going concern. But whenever it does not go well, that is where the auditor is also under the scanner. If you see the way the regulatory things are coming, and which Lamia will take again in the next session, as I said, for NFRA, the regulator is closely looking at some of the areas, and one of that area is going concern. as to how the auditor has evaluated going concern, because as I said, it is the third party's money at stake. And if auditor does not say company will not survive, think of a bank. If the bank goes down tomorrow, then the question comes on the auditor saying that what was auditor doing? How come auditor could not come to know that the bank is going to go down, right? That doesn't mean that every time the auditor is wrong, because as I said, auditor is not a fortune teller, right? So something might have happened after the balance sheet date, and because of which it would have gone down. So no, I'm not saying the auditor is blamed every time or is to be blamed every time. But yes, the auditor has to be conscious enough that have I done my duties properly, or did I miss something? I should have known this when I was doing the audit of 31st March. If that be the case, that auditor should have known, then boss, you are in a problem, because then the regulator is going to catch. Any questions on the going concern, or anyone would like to share any experience on going concern without taking name of your client? Yeah. Yeah. Right. Sure. Any thoughts on this? The question he has asked is, it's a company, but during the year it's a company, but before 31st March it's a company, but before I sign the audit report, it is getting converted into LLP. So company doesn't exist anymore. Will that have any impact on my going concern evaluation? Someone said no. And also, if the reasons, any reasons why no? Or why? Yeah. Ha. Ha. I agree with you, sir. Yes, I agree with you. So therefore, if the company is getting converted into LLP, but company is going to still run, the business is still going to run, then there is no going concern problem, right? Because the standard doesn't apply only to companies, it applies to entities. So my entity could be partnership firm also, it could be company also, it could be anything, it could be trust, anything. Also, similar question comes, for example, on 31st March, I am signing the balance, 31st March, the company exists. But before I sign the audit report, the company is going to get merged with someone else. And therefore the company, after signing of my audit report, the company will not continue because it is going to get merged, which is already known when I sign the audit report. So do I prepare the financials on going concern? Which fact? This merger fact? I would expect, yes, this should be reported. And that was my next session on subsequent events, that this is a significant event, though it is not an adjusting event. It's like called as non-adjusting event. But because it is so material, it should be included by the client in the notes to say saying that they are converting into LLP post 31st March. Right? Same case goes with the merger, the question which I asked. Just because the company is going to merge with someone and therefore going to die, so to say, doesn't mean that going concern is a problem, because as long as the business is going to get continued in the new firm or new company, that is the acquirer, most of the the schemes for the arrangement or schemes for the merger, if you see, they will say saying that the company will merge with this company on a going concern basis. That is what even the wording is used. So the business continues, and therefore going concern is not a problem in those cases. But if the company is going to close down for whatever reasons, there is a shareholders dispute, for example, and PE investor says, PE investor is going to withdraw his money, he doesn't want to continue with this company anymore, then yes, then there will be a problem. Going concern has become a very common problem, especially those companies where PE has invested, private equity fund has invested. Because if they do not get the return, they are going to stop the tap. Then you won't get the investments anymore. And if you don't have money, you can't run the business. So it also depends, right, on the nature of the client. When you take the client, the first thing should come to my mind is whether this company will run as a going concern. Yeah.
Can I ask a question?
Yes, please.
This is again from the perspective of users of the financial statements, people who use the financial statements.
Yes, you're right.
And this is in the context of outcome fee.
Okay, MUGC. Yeah.
The question is, I can understand there is an emphasis of time.
Yes.
And it says that adjustments they have to be made.
Yeah.
They have not been made.
Yes.
So as an average user of the financial statements,
Huh.
how am I supposed to read this?
So MUGC paragraph in the audit report will also refer to the note which management has given, because management is also supposed to include a note, and confirm that there is a material uncertainty for them to continue as a going concern. Because these are the events typically which are outside the management's control. Like management also doesn't have a certain answer for it. They are also uncertain what is going to happen. And when I refer to the note in the audit report, the note should explain what are those factors because of which the company is having the problem and what is that uncertainty which the company is having. So that, as you rightly said, it is meant for the user and therefore the reader knows as to this is where the company stands. Now, if I am an investor, then I will have to take my own call as to whether I invest in this company or I don't invest, because this company may go well if the things go in their way. But if winds are against them, then they will fall. So I'm taking that risk as an investor based on my gut feel. If I'm a banker, obviously my interest rate will be much higher. Credit rating of the company will be too low.
But I'm not qualifying my financial opinion.
Exactly. We are not qualifying.
But as an investor, as you said,
Yeah,
it's my call whether I invest in this company or not.
exactly.
But if it is not qualified,
Yes,
then I'm saying my opinion is not qualified.
exactly.
And it can it impact
Correct.
an average user
Yeah, yeah.
of financial statements? What do they make of this?
Sure. So what happens is I'll step back a little bit. Maybe this may get covered in the last session today, which is on the audit report as to qualification, EOM, etc. But I'll just touch on it. Why would I not qualify when it is a MUGC? That's the question, right? Why will I not qualify when it's a MUGC? And I will say my opinion is not modified in respect of this matter. Any thoughts? The answer is that my opinion is saying, if you see the opinion paragraph, my opinion will say it's a true and fair. Now, the company has prepared the financial statements giving a true and fair view, because this is the uncertainty which company also does not have the answer. So based on considering all today's facts, company is presenting the financial statements and that is prepared on a going concern because it may continue. If the uncertainty is resolved in company's favor, it will continue. So it should not be preparing the financial statements on liquidation basis today, because it is not going to get wound up. They have the full intention to continue, provided, let's say, they get money or they win the case or whatever. So I can't call that these financial statements are not true and fair as auditor. I can qualify only if I can say that there is a misstatement in the financials. These are not true and fair. But in MUGC, I cannot say these are not true and fair. These are true and fair because that is the best which management could do considering the facts known today when they are preparing the financial statements or board is approving the financials. That's the reason.
Are these standard setters even thinking that require management to give a range of possibilities?
Yes.
Things like uncertainty, material uncertainty. Are
Yeah.
standard setters thinking that give a range of possibilities? What could be the level of adjustments?
Yes, that is true. So the expectation in this case, MUGC case especially, or even in close call case also, the scenario 2 case, which is little better than MUGC, is the note which management gives is expected to explain full facts along with whatever mitigating factors which they have considered as a management while evaluating their going concern. Somehow what has happened is those cases where going concern did not continue, for those clients, regulator has caught the auditors, they're raising the fingers on the auditors. I personally, I believe that there are also needs for the regulator to raise the fingers on the management also, right? Because management is the first one who prepares the financials. They know their business well. Today, let's say, suppose if I'm having a fight between me and my son is going to leave the house, I will be the first person I know that this is happening. My neighbor will not know that this is happening unless I tell him. So auditor is always outsider. Therefore, obviously, auditor to a certain extent is constrained from having all the facts unless the client expresses. And that's where this other concepts of audit, which we are not covering today, but like professional skepticism, which is again always referred to, that is where it lies, saying that to what extent skeptically we are taking the management representation on the face, or are we challenging it? Going concern is always challenged whenever the going concern issue arises. Because if the client says that there is a going concern, and as an auditor, if I have even a slightest of the doubt that this company may not continue, I must challenge the management tooth and nail, so to say, to get myself convinced that this will be okay. Right? Yeah. Huh. Yeah. Yeah. Yes. So Yes, you're right. So it depends on the situation. So I think one situation which Bipin mentioned was there is no dispute in the shareholders. They decided that they will convert the company into LLP. And therefore, it's like a smooth transition on going concern business. The business will continue and the legal form will change from company to LLP, which this other gentleman also said, saying that, it's just a change in the legal form, but the entity continues. Second case could be shareholders are fighting and the entity will die. Uh, Someone will not allow it to get converted into LLP. If that be the case, then you are very right that then as an auditor and also as a management, they will have to think as to why going concern is appropriate, because the shareholder will not allow it to continue anymore, right? These things many times we have seen even family disputes. There is a family dispute and the father started the business and then there are two sons, now they are fighting, both are going in opposite directions and the entity may not survive if this is how they behave. Exactly, exactly. And the management also has to put the note accordingly. Huh. That's what his concern is, that because the shareholder is dissenting, he is saying that LLP will not come into existence. No, but I have to issue the audit report for 31st March. So 31st March, the company existed. I have done the audit. That's true. But what will I do in my audit report of 31st March, which is a company's audit report? I'll have to say whether this company is a entity, is a going concern or not. Now, if the shareholders are fighting and therefore it cannot get converted into LLP, then in that case, going concern is an issue. But if it is a seamless transition, the way he was saying, then it is just a change in the entity. Then going concern is not an issue in my report. Okay. Moving to, yeah, sorry. Sure, sure. Yeah, now moving to the next topic, I think, yeah, Bipin is worried about the time, yes. So moving to the next one, which are little simpler topics now, is on the subsequent events. So subsequent events, well, it's interesting because there is an auditing standard, SA 560, and there is also Ind AS on this. So accounting standard and auditing standard, both are there. Both go hand in hand in a way. I'm sure we all understand the meaning of subsequent events. The name it says, it is subsequent to the balance sheet date. So after 31st of March, something has happened before I sign the audit report. Then what the entity is supposed to do, what am I supposed to do? Am I to take the cognizance of that event, or am I just to say it is after 31st March, so it doesn't matter? But the concept doesn't stop there. There is also a concept of date when the financial statements are issued, and how, if something happens before the financial statements are issued, then I will, as an auditor, have to change my audit report. The company will have to change their financial statements. If those are already issued, then the auditor responsibility to that extent reduces, because the financial statements have gone out, audit report has gone out, and auditor is not required to do any audit procedures after the date of sign off. That is what the general principle goes.
For all practical purposes,
Yeah.
the date of approval and the date of issue of the audit report is the same.
Now, that's always an issue, and that's where, if you see the slide now, the institute issued the implementation guidance on SA 560. Right? How do I decide when the financial statements are issued? Because in a company, what will happen is that 31st March year end, then the financials are getting, let's say, ready by 15th of May. Auditor, the board meeting happens on 15th of May. Auditor, the board authorizes the financial statements for issue. Auditor signs on the same day, on 15th of May. And then the financials will be, if it's a listed entity, they will go to stock exchange, the results. Now, once they go to the stock exchange for listed entity, that is considered that the financial statements are issued. Though the complete financial statements are not issued, it's only the results, one pager which is issued. But as per implementation guide, that is the date of the issue. And therefore, anything happens after that, let's say, but before the AGM, auditor is not required to do anything as far as subsequent events are concerned.
From 15th May to the date it is issued to the stock exchange,
Huh.
something happens,
Yes,
the auditor is supposed to revise the opinion.
exactly. Then the auditor is supposed to revise the opinion. Normally, it goes to the stock exchange within few hours. But let's say if it is not a listed entity, and that is where that second bullet is. That if the financial statements are going to any third party, or if it is not listed, so that will be given to the shareholders, right, along with the notice of the AGM, and then the AGM will be held. Till the time the notice goes or the financial statements get distributed to the shareholders, those are not issued by the company, and therefore, if anything happens till that date, the auditor will have to withdraw the audit report and issue the new audit report, or modify the existing audit report. And the company will also have to make the changes accordingly. A common example would be, let's say if there is some merger which happens. So the merger happens through court, NCLT, etc. Now up to the date when auditor is signing, merger has not happened. So therefore financial statements do not give effect to the merger. But after I have signed, but before the financial statements are issued, the court passed the order that merger is effective from retrospective date. Then I'll have to include that company also which is merged with me in my financials, and therefore I'll have to revise the financials. Auditor will have to revise his audit report. Right? And that's what these slides talk about, saying that when do I consider subsequent events, when do I do not consider subsequent events. As you know, subsequent events are of two types, adjusting events and non-adjusting events, right? Adjusting event is something where even if the event has happened after 31st of March, I will have to change my financials because it is an adjusting event, which shows that the position was existing as at 31st of March. My debtor has gone bankrupt in April. I should make the provision as of 31st of March because then he was anyway going to the bad condition over the last 6 months, for example, right? So those are adjusting. There could be certain non-adjusting event, like the way sir said, saying that my company is getting converted into LLP, which happened after 31st of March. The decision is taken, and therefore that's a non-adjusting event which will require only the disclosure if it is material. If it is not material, then even that is also not required. But as an auditor, we should have that work paper in our file to say which are those subsequent events which we have looked into and how those have been dealt with by the client as well as by the auditor, to ensure saying that we have followed the standard. I will not go through the theory because that is what the principles are, which I explained. And then I will go to the last part, which is audit of the accounting of estimates. Now this is the auditing standard which very commonly, unfortunately, ignored while doing the audit. We do the audit of the estimates many a times similar to the way we do the audit of the petrol expense, right? Which is very wrong because estimate by name itself shows that there is an uncertainty. What are the estimates which you see the client makes in their financial statements? Any examples of estimation? Yeah. Exactly. Provision for bad debts, if it's Indian GAAP, or in Ind AS we'll call it as ECL, expected credit loss, which is like a provision. Now that's an estimate, right? Whether my debtor will pay or will not pay. How many of debtors will pay and how much amount is doubtful. That's an estimate. Any other example? Provision for litigations, provision for warranty. In fact, my entire provision section is estimated. There are some estimates in that. That's why it is called as provision and not as a liability, right? So all those estimates are there which the client makes. As an auditor, do I have any responsibility towards that estimates which I need to do differently from the way I do my normal audit of petrol expenses and conveyance expenses and telephone expenses? The answer is yes, because estimates by their nature involve a lot of judgment, a lot of uncertainty, and therefore I'll have to question the client as to how he has arrived at an estimate. He also would have followed some process. He would have used some inputs. He would have made some assumptions. He will say my input is my historical data. Last 3 years this has been happening, and therefore I believe in 4th year also this will happen. So that's my input. There could be some assumptions which he will make. Like he'll say the market is getting better now. The COVID is over. And therefore I expect that this debtor will pay because my debtor is going to be in a better financial position. So there could be certain assumptions which he will make. And after having all those inputs and after having all those assumptions, finally he will come out with some answer of the provision. Now as an auditor, I'll have to audit the inputs to ensure that all those inputs match with the underlying data. Those could be company's data, like historical data. Those could be market information. For example, if it's investments, company has invested and they are going to decide whether there is any provision in value of the investments which is required because the share prices of the investment have gone down. So market data will be the share price trend on which he will make the estimate. So as an auditor, first I'll have to verify whether input data is right, and second I'll have to verify what is the reliability of those assumptions which he is using. Are those assumptions reliable? Today if I'm going to saying that rupee to dollar movement, I expect there will be 1 to 1.5% movement next year, could be a reliable assumption. If I say that dollar and rupee movement is going to be 10% next year, completely unreliable because such movement has never happened and economy will collapse. So that is where the auditor's judgment comes into play, that to what extent I accept assumptions which are made by the auditor, by the client, and to what extent I do not accept that. more complicated the estimation is, one will need the expert. And as a auditor, we may not be able to kind of vouch that or put a tick on that. For example, impairment calculations. Impairment calculations may require more of a business knowledge and also the Excel modeling basis which it is done. So you may need some expert, but still to an extent it is doable because end of the day it is Excel. But if it is fair valuation of investment property, let's say the real estate, one would need to go to the expert to say saying that what is the real estate market, what is the rate which is going on here. If it's a fair valuation of a derivative or some financial instrument, you will need some financial instrument expert who is a valuer, who can value that investment and tell the auditor saying that yes, this is the fair valuation which we accept. So those companies or firms where there are these complicated clients, we also have the team of experts. So typically as an audit team, I'll give it to them and I'll get a memo from them where they will say saying that these are acceptable assumptions which the client has made. So as an audit team, I will check only the input data because that I can straight away check, go back and check with the history or market or whatever. Assumptions I cannot check. So assumptions expert will confirm. And that is how by put together, one will get the comfort on the final result, which is the estimate which the client has made, which could be derivative value, etc. But in a simple one like provision for warranty, etc., I may not need the expert. Now that is where the documentation again plays a role, because one will have to see that in my balance sheet or in the P&L, what are those items which are estimated items. And for all those estimated items, do I have the sufficient audit work paper in my file as what work I carried out as per the auditing standard to do the audit of those estimates, because those estimates may go wrong in future year and the time is not very far. In the next year only one will come to know that this estimate was completely incorrect, right? And that time the auditor will also get exposed. So it's not an estimate of next 50 years. It's the estimate of just next 2 or 3 years. The good part will be that if at all by the time you sign the audit, the actual data is already there, then the estimation is easy because you already know the result. But many times that is not the case. And that's where this complexity creeps in. So that is what the audit of accounting for estimates is concerned. I will not go into detail because this standard is again something where depending on what estimate you are auditing, you will have to develop your audit procedures. There is no standard tick check and box which I can show you saying that okay, you carry these procedures and all your estimates are done, right? It's very estimate specific.
The use of the work of experts.
Yes.
Right? What is the liability of the investment partner?
Yeah.
In certain complex estimates, like as you mentioned, derivative,
Correct.
etc.
Correct.
I can check the inputs
Yes.
as an audit partner.
Yes.
But do I have any other responsibility to understand the reasonableness of the estimate? Or
Huh.
do I just say that an expert has come and done it for me?
Yeah.
I cannot be blamed for anything that goes wrong because I have just
Yeah.
tested my inputs.
Correct. So I think what you mentioned, the two situations, those are the two extremes and answer lies somewhere in between. So if I am auditing, just to repeat the question for everyone, what he asked, he's saying that there is a complex financial instrument, derivative or something, and the derivative is being fair valued by the expert, but it is there in my balance sheet. So as a partner, I'm supposed to sign that balance sheet. What is my responsibility as far as that carrying value of the derivative is concerned? Because frankly, I have not participated in deciding that carrying value at all. It is done by the expert because it's a fair value, right? That's the question. Now the answer to that is, am I completely responsible as a partner when I have used the work of that expert? The answer is no, right? Because it is understood saying that as an audit partner, you do not know the complexity of that particular financial instrument and you have used the expert. So to a certain extent, you are relying on the work of the expert. And there is a separate auditing standard, right, on using the work of an expert. So therefore, you will have to follow that standard as to how you have used the work of the expert. That also requires certain procedures to be done by audit team. Like who is the expert? Have you evaluated whether that person has got expertise or required professional degree, knowledge, experience, etc. The information which is given to him is your responsibility. Whether you have verified that information which is given to him is correct, because it's like garbage in, garbage out in their model, right? So if you give a wrong input data, obviously the answer is wrong. Input data is my, as a audit partner's responsibility. Assumptions is his responsibility because he is expert. And therefore I should have, to start with, I should have the engagement letter with that expert. I should have audit work paper which explains that this expert is really the expert. He has the knowledge, he has the degree, he has the experience, etc. The third, I should have a clear signed report from that expert where he will confirm that this is what his output is. because he also may have some concerns which he will put in the report. If he raises some concerns or some limitations, then as an audit partner, I will have to do more work to ensure all those limitations are addressed, because he has taken away his hands. So it can't be the case where neither he takes the responsibility nor I take the responsibility. And that's why I said the answer lies somewhere in between. There is certain responsibility on the partner also, but there is also certain responsibility on that expert as well, on which the partner can rely. And that is where that thing will come up. Good. Any more questions? No. So thank you very much for the patient hearing as well as the interactive session. The real kind of achievement of this last 1.5 hours would be when you go back and you start looking at these auditing standards and start applying it in your real life situations, whether it's audit of the estimates, whether it's subsequent events, whether it's going concern, or the first one, which is external confirmation. I'm sure external confirmation will be applicable to everyone, all those who are doing the audit, because that's a very common situation. Going concern depends on whether the clients, what type of clients you have. Subsequent event, surely it will be, because one is supposed to do the review of subsequent events before one signs the audit report. And estimates also, I believe everyone will have some or the other estimate in the balance sheet, which one should look into and accordingly document it. So thank you so much. It was really nice to share my thoughts with you. Thanks a lot.